This recording we're going to take a look at another key accounting standard, which is IAS 8. This covered accounting policies, changes in accounting estimates, and errors in the financial statements as well. So it's a key standard, one of the earlier ones, IAS 8, the lower number, and it's quite important in terms of linking it to the overall financial statements and of course the choice of accounting policy and the presentation of financial statements. So there are choices allowed in various accounting standards. Think of IAS 40, investment property. You can use the cost model or the fair value model. There's also choice in IAS 2. You can use FIFO, first in, first out, or weighted average. So we need rules around how you make this choice and how it's accounted for, so to ensure comparability. So you can't choose the cost model one year, then the fair value model the next year and keep switching. Likewise, you can't just change from the FIFO method to the weighted average without some rules around how you present those changes in the financial statements. So that's the first one, dealing with the choice of accounting policy and the change in accounting policy. Then the next key thing that we've come across already is like financial statements are based on various estimates. You have an estimate for bad debts, you have an estimate for a provision for bad debts, you have an estimate, for example, for depreciation. And all of those are required to do calculations and to input numbers in the financial statements. Whereas IAS 8 gives us the guidance, well, what happens if that changes? Like we've dealt with this already, the change in a bad debt provision, the change in depreciation useful life. But actually this is where the rules come from. IAS 8 dictates how you deal with a change in accounting estimate. And also IAS 8 gives you an idea what happens if you have an error in prior years. You found out there was something calculated incorrectly, or you found out that maybe there was fraud and the financial statements are misleading in prior years. IAS 8 again gives us an idea of how to update for prior period errors. Right, so the scope here, particularly, it prescribes criteria for selecting and changing accounting policies. So we'll focus on accounting policies first, then we'll look at accounting estimates, and we'll look at correction errors, because they are slightly different in terms of how they're accounting for. But you're going to think in that regard, that's a fairly fundamental standard. Like the choice or changing accounting policies. I mean, that's very fundamental to the whole financial statements. And you'll see one of the first notes after the financial statements in any annual report that you'll see is a summary of the accounting policies. So it's a hugely important standard to get right and to understand what it prescribes for companies who wish to change their accounting policies. So what are policies? Well, they're specific principles, bases, conventions, rules, and practices. Like if you think we have the cost model is an accounting policy under IAS 16. The fair value model is an accounting policy in IAS 40. Some standards, they don't provide choices in accounting policies. You have to do something or the other. For example, IAS 23, you have to capitalize borrowing costs when the criteria is met. But in other standards, the likes of IAS 40 or the likes of IAS 2, you might have a choice in accounting policy. And with that choice then comes, well, how do we figure out which is the best policy to use? And what's the criteria we can use if we need to change accounting policy? Right? And that's where IAS 8 comes in. IAS 8 says you can change accounting policy if one of the following conditions are met. It's required by a new standard. So for example, you might have the implementation of a new IFRS, which requires you to change how you account for something, your accounting policy, or you believe the change is necessary to give more relevant and reliable information. So you believe the cost model in IAS 40 is not giving reliable information, so you want to change the fair value model. So you're the only two reasons that you can change. And you have to be able to articulate your justification for that change in accounting policy in the financial statements as well. All right. So it'll be only allowed by two. Required by an IFRS to give more reliable information. Right. And when an initial application of a new standard of an IFRS does not give you transitional provisions, you must change an accounting policy. This is a key one, retrospectively. Right. So that's the key issue here is sometimes when you have a new standard, the new standard will tell you this is how you transition. So when we had the implementation of IFRS 15 revenue or IFRS 16 leases, those standards gave you an idea this is how you transition from the old standard, IAS 17 and IAS 18, to the new standards. Whereas if it doesn't tell you that, or if you're changing an accounting policy just because it gives you more reliable information, you must change it retrospectively. What that means is you must go back and change prior year accounts. So that means you will adjust the opening balance of retained earnings i.e. the equity, and you'll be adjusting the comparative figures for each prior period. Usually there's only one prior period, last year's accounts, in the financial statements. So that's a key thing to watch here is if you change an accounting policy, you must go back and say, what would the financial statements have looked like last year if this change was already implemented? The logic for that is to ensure comparability between this year and last year. There's no point presenting financial statements this year that use the fair value model in IAS 40 and then go back and last year's ones use the cost model. They're not comparable. What you need to do is go back and adjust last year's for the cost model as well. And we'll look at that in a second and we'll see what that actually means. That will mean adjusting opening retained earnings for that prior year change. So when we talk about accounting for something retrospectively, it means go back and adjust last year's figures. Even those last year's figures were finalized and they were right at the time they were prepared, it's now a fundamental change. And you need to go back and see how were the financial statements being presented if you always chose this accounting policy. So again, to promote comparability. So let's look at a good example of this. So we're looking at an example of Bloom, who purchased an investment property in 2017. They purchased it for 2 million and decided to adopt the cost model and useful life of 40 years. So we know the cost model for investment property is IAS 40, and you just depreciate it like the cost model in IAS 16. However, they also tell you over the next couple of years, here's the fair value. Now that fair value is not relevant for accounting because you're using the cost model, but of course under IAS 40 you must disclose the fair value at the end of each period, even if you are using the cost model. They give you the closing retained earnings in 2018, and they give you the profit for 2019 was 286,000, assuming the cost model. During 2019, Bloom's management decided the fair value model would be more appropriate for investment property. So they're using this choice where it gives us more reliable and relevant information. So they're changing accounting policy. Now the key thing here, and we'll bring up this so we can write it side by side, this is a change in accounting policy. Right? IAS 40, cost to fair value model. Change in accounting policy. Right? So what you need to do is need to go back to 2018 and adjust as if the fair value model was implemented here. Now that's a key thing. You need to go back retrospectively and say, well, if we had implemented this back in 2018, then what would the opening retained earnings be at the start of 2019? So you have to take it in different steps and we'll work our way through it. First thing is the cost model. In the cost model, your depreciation each year would have been 2 million divided by 40, which would have been probably 50,000, is it? 50,000. 50,000 per annum. That's how the cost model works, assuming no residual value, and there you divide across the useful life. So in the cost model, the net book value at the 31st of 12/17 would have been 2 million minus 50k, which is 1.95 million. And in the net book value at the 31st of 12th 18 would have been 1.95 million minus 50k, which is 1.9 million. Just do it all consistent. So that's the way they would have originally done it. So they said, using the cost model, we took depreciation off. So take off 1 year's depreciation into 17, another year's depreciation into 18. But they're saying during 2019, they decided that the fair value model would be more appropriate. Now remember, this retained earnings at the end of 18 is assuming the cost model was used. This profit figure for 19 assumes the cost model is used. We need to go back and make those changes. Right? So if we changed to fair value model at end of 2018, because again you have to go back and retrospectively change it, so you can compare 2018 and 2019 at the same time period, well, what would it look like? Right? How will you compare? So you would say cost model net book value equals 1.9 million. We've already calculated that. Fair value at the end of 2018 is actually 2.5 million. We're given that in the question. Fair value, that's a gain. Or if you want to call it the difference. The difference there, 600,000. So what we're saying there is, and this is important, is we're saying the carrying value of the asset is 600,000 bigger because we've changed the accounting policy. Because we've gone from a cost model, which would be 1.9, to the fair value model. Right? And that will be reflected in the 2018 accounts and the opening retained earnings as well. So what we're going to show here is we're saying actually the retained earnings, so for example, if you were doing the statement of change in equity for a year ended 31st of December 2019, be careful now, the current, and we're looking at retained earnings. Your opening retained earnings, we're told here, is 2.8 million. Right, that's given in the question. Your opening retained earnings. But watch what happens. You have now a new line, change in accounting policy. So you have a new line and you say that's actually 600,000. So that is opening retained earnings. Watch what I say. We say restated, which is now 3.4 million. So that's an important one that you understand where that 600,000 comes from. We're saying if we implemented this at the start of 2019, i.e. in 2018, the carrying value would be 600,000 bigger. You wouldn't have depreciated, that'd add back 100,000, and the value has actually gone from 2 million up to 2.5 million. So the net impact is retained earnings, your profits in previous years would have been gone up by 600,000. And you show that as a restatement to the opening retained earnings in this year. So you're saying if we adjusted this in prior years, the cumulative impact will be a 600,000 increase in our retained earnings. And then the 2019 profit, be careful, 2019 profit, now that's not necessarily restated because again, you're preparing this in 2019. So what you're saying is this draft profit figure of 286, and I'll put it here working one. That draft profit figure 286, if you come down, draft 2019 profit, you need to add back depreciation because that shouldn't have been taken off. It's no longer the cost model. And what you're going to do there is you're going to add on fair value gain, which is 100,000. Right, so watch for that there when you're having a look at it. What we're saying is the draft profit for 2019, because this is still the current year, you'd make the changes here. That was using the cost model. So in that 286, there must have been 50,000 charged for depreciation, which has to be added back because it's not relevant. And you don't depreciate under the fair value model, you just recognize the increase, which is 100,000. So that means the updated 2019 profit is 286 plus 150, which is 436. And you slot that in, profit for the year, 436. So that means your closing retained earnings at the end of 2019, just tie those together so it's easier to read, is 3.836 million. All right, so there's a bit of work there to get used to where those figures are coming from and to get an idea of what's going on. So look at what we do. We say, right, that's fine. Start off with the basis that we're changing accounting policy. And you start off with the basis that this was changed last year. If it was changed last year, you'd have a difference in carrying value of 600,000. That means the opening retained earnings for 2019 should be 600,000 bigger. And we show that by putting a separate line, change in accounting policy. And then you have a restated opening balance and you update your profit as normal. You make the adjustments for this year and continue on. So for next year onwards, there's no such thing as depreciation because you're using the fair value model and you recognize the fair value gain or loss through the P&L each year. So there's a bit of work there, the new line in terms of how the change in accounting policy looks. And what we'll do now is we'll have a look at the model financial statements that are up on Loop because they give you a good idea of how this is presented in a bigger statement of change in equity. So if we look at the model financial statements and we come down and we look at the statement of change in equity in particular, which is this one, the next one here. So you can see here, this is just, it's across 2 pages. So I think if you bring it out, you might be able to see them back to back, but it's just across 2. That's why it kind of looks a bit funny. But you can see here the balance at the 1st of January, the effective change in accounting policy is served as relevant based on IAS 8, and then the balance restated. So you see the way that when you have a change in accounting policy and you have to go back and adjust prior year, you put it in there. The prior year impact on retained earnings is capsulated in a single figure, and then you have a restated balance going forward. And that's IAS 8, paragraph 49. So that's what I like about the model financial statements. You won't always see that in all the company financial statements because some of them won't have a change in accounting policy, or some of them won't have prior period errors. So you won't see that. But if we go and we control F and we look for IAS 8, we keep coming down, we get the notes as well. There's your IAS 8. So again, second note, IAS 8 again, it describes the change in accounting policy and it shows you the impact. In the notes, you have to give a much more detail of what was the impact on your P&L. So for example, we'd be disclosing in our example the reduction in depreciation because it's no longer the cost model and the increase in the fair value gain. So what's the impact on profit in that year and the previous year? Likewise, what's the increase or decrease in the net assets in previous years as well? So that's your change in accounting policy. It has to be, and look at all that coming from IAS 8. You have to give a detailed description in the notes of what the key adjustments are. Right? So that's when you're dealing with a change in accounting policy. It's retrospective. You adjust the prior year as well, and you explain them, you show them in the notes, compare like for like. In most exam questions that I'll give an AC220, you won't be preparing the final or the second year's accounts. You'll only be preparing this year's, but you will still have to adjust opening retained earnings, which will be in the statement of change in equity. So you still need to know how to approach that. So that's a good example, moving from the fair cost model to the fair value model. There is one exception to this in terms of change in accounting policy. Technically, when you're going in IAS 16, IAS 38 from cost model to revaluation model, that's a change in accounting policy as well. But IAS 8 says you don't have to apply that retrospectively. So if you remember doing any IAS 16 revaluations to date, we've never talked about adjusting prior year. We've only adjusted accumulated depreciation and cost in the current year and work forward. That's because it's a noted exception in IAS 8. So even though it is a change in accounting policy, you don't have to apply it retrospectively. So that simplifies it a small bit in terms of your accounting for that, particularly the IAS 16 revaluation model. The next one we're looking at is accounting estimates. Now again, estimates are different than accounting policies. Policy is a much bigger thing, a more formal thing, dealt with in a lot of accounting standards. Whereas accounting estimates, like the useful life, residual value, property, plant, and equipment, depreciation, whether using straight line or reducing balance, or your estimate for the provision of bad debts. All of those are subjective estimates and they're revised every period. Fundamentally different in accounting policy about how you measure something or the policies you choose to recognize something. These are core estimates. There's much more subjectivity around them. So when you're updating accounting estimates, updating your bad debt provision, updating your useful life on property, plant and equipment, your residual value, they're not applied retrospectively. They are applied what we call prospectively. So it's much more simple. What we mean is you make the change in the current period and you don't adjust comparative figures. So that's much more straightforward that you don't have to go back and adjust prior year. You can adjust it in the current year and use that going forward. That's what we mean applying it prospectively. Make the change this year and in future years. Don't worry about changing prior periods. So this little example here, Apple reviewed its depreciation in the year in 2017 and it was decided that the remaining useful economic life of machinery was 3 years at the 1st of January 17. Your given machinery cost 3.6 million in 14, 10-year useful life and no residual value. How should they account for the change at the year in 2017? So again, let's get a think about what's going on here. So cost 1st of the 1st, 14 is 3.6 million. Depreciation on that basis is 360,000. Now that shouldn't cause students too many issues because it's quite straightforward from the question, where you're told it's 10-year life, 3.6 million 10 years, no residual value. So that will be for 2014, 2015, and 2016. 3 years depreciation before this change happens. So the net book value at the 1st of the 1st, 17 is cost 3.6 million, accumulated depreciation, which will be 30% because 3 years at 10% each, which is a million and 80 should I say. Your net book value is 3600 times 0.7, 2520. That's the net book value at the start of 2017. Now, what they said at the start of 2017, they reckon the useful life was 3 years. So the new depreciation, which is an estimate, is 2520. What's left, the net book value, divided by 3. And that's what you're going to do going forward. 2520 divided by 3, which is 840,000 per annum. So what you don't need to go back and say, oh, we should have done that since 2014 and write it off. This is a change in estimate. Your estimates can update every year. You don't need to go back before 2017 and adjust. You just make the adjustment from 2017, charge 840,000, and in 2018, and in the last year of its useful life, 2019. Right? So it's a much more simple approach than a change in accounting policy. You don't need to go back retrospectively because you're told in IAS 8 that's how to account for a change in accounting estimate. Right? So that makes it a bit more straightforward in terms of that accounting. So, and we do that anyway. When you change a useful life, when you change a provision for bad debts, as you've done in a lot of IAS 1 questions already, you never go back. You never adjust prior years. You just do it this year and move forward with the adjustment. And your actual core technical reference there is IAS 8. That's the one that gives you the guidance how to account for change in depreciation, how to account for a change in useful life or bad debt provision. All right, so that should give you a good idea of how to approach change in accounting estimates. Quite straightforward. You do it this year and go for subsequent years then if it impacts subsequent years. Your last one then is prior period errors. Now, if an error is identified in the current period, so you identify an error when you're doing the accounts for 2020, well then the focus in IAS, they can be corrected immediately. That's not the focus of IAS 8. IAS 8 is on prior period errors where the financial statements have already been finalised. Because where they've been finalised, you need to go in and adjust them. Whereas if you're making the accounts and you realise, oh, depreciation, there's an error there, or there's an error in revenue, you can update them before the financial statements are finalised. So that's why it says here prior period errors. We're only interested in errors in previous reporting periods. So an entity must correct all material. That's the key thing here. Right, we're having a look at all material prior period errors. So what we're saying there is material, you're generally thinking if it's bigger than 5% of profits or bigger than 5% of assets. But usually most exam questions will give you an indication whether it's a significant amount of material or not. If it's only a very small amount relative to the size of the business, well then you can just adjust it in the current year. But the material prior period errors must be adjusted retrospectively. So again, similar to what we've done with change in accounting policy. If you spot an error in depreciation that's material, you need to go back to last year's accounts, update that depreciation, which then updates opening retained earnings, and it will also update your opening net asset figure in terms of property, plant, and equipment. So you have to go back to the earliest period in which the error occurred. But generally for you, for the exams, you'll just be going back to the prior year and updating the opening balances brought into the current year. You won't be preparing more than one set of financial statements, but you will be asked to explain the accounting treatment. And if it's a material prior period error, you must apply it retrospectively. When the error is not material, which means it's very small, so for example, if you have 20 grand error in a profit of a company that's 2 million, that's not material. Generally, the rule is about 5% or more. If it's not material, just make the adjustment in the current year P&L and go forward. but if the error is material on a cumulative basis. So for example, the errors compound each other each year because it's been done for a number of years, then you must make the adjustment in the opening retained earnings of statement change in equity, right? To reflect what the impact would have been if this was adjusted in all the prior year financial statements as well. So it's very similar treatment to change in accounting policy. You go back and see what impact would this prior period error have had on previous year's financial statements, and what impact would that have on the opening retained earnings as well. So the best way to look at that is let's look at a real example and work our way through it. So Dodgy, a PLC company, is preparing its financial statements for year one when it discovers that the prior year financial statements recorded an incorrect figure for depreciation. It transpires that the prior year figure for depreciation has been understated by 200,000, and you can assume this is material. So I'll give you that indication in any exam question. To fix that, Dodgy have increased their year one depreciation by 200,000, i.e. the current year, with no further adjustments will be made. Provide any journal entries required to adjust for the above, and briefly discuss the impact of the prior period error. So the key thing here is that's not allowed in IAS 8. If it's a material error from a previous period, as we're told, you're not allowed just to adjust this year's depreciation charge, which year one is the current year. You must go back and adjust previous years. So we're looking for a student, if that came up in an exam, to be referencing IAS 8, to be referencing this is a prior period error that's material, and to be referencing that you have to apply that retrospectively. So when you're briefly discussing it, that's what we're looking for. You reference the technical standard, you reference to the guidance, and then you provide your journal entries to explain what the treatment will be. Right, so we'll set up this and we'll see can we give our key journal entries and the key explanation as well. So again, if you're explaining this, you'll be referencing IAS 8, you'll be saying material prior period error, and you'll be just saying there retrospective adjustment. So again, you don't expect essays in this exam, but we expect you to be able to articulate the core technical references and explain the treatment. So it's not right there to debit depreciation this year. So you're going to credit the SOPL 29, or we'll say year one, 200,000, and you're going to debit retained earnings, 200,000. Now you might think surely that's the same thing, but be careful, it's presentation wise, it's different. So when you come to the statement of change in equity, you're going to have an opening balance on your statement of change in equity. We'll say it's X. So we don't know what the opening balance was, and this is the opening balance, be careful, on the 1st of the 1st, year one, which is just the way the question is set up there. So in your retained earnings, you have the opening balance in year one. You will then say prior period error. And the impact of that prior period error, 200,000. So you're going to say restated balance, 1st of the 1st, year one, which will be whatever it is, X minus 200,000. So it should be presented like that to say actually this 200,000 was coming out of last year's accounts, and this opening balance retained earnings doesn't reflect it. So you'll present it like that in terms of this figure would have been in the financial statements last year. So you have to show it this year so that the users can reconcile back, and then you'll show the prior period error impact. Same as like change in accounting policy. And there'll be a note to the accounts explaining the impact of the prior period error. Now this ignores tax. The next example we look at in a second might have the impact of tax as well, so we'll get an idea how that goes about. But in this one here, we're looking at you take it out of the P&L this year, so the profits for year one will be increased by 200,000 because you shouldn't have had that depreciation in there, and the opening retained earning will be less 200,000 because that 200,000 should have come off last year's accounts, for example year zero, and that means the opening balance retained earnings should be 200,000 lower. So it's the same presentation in your statement of change in equity. And if we look at the model financial statements here, and we go to your note 2, which is back another couple here, where we had the change in accounting policy, it also gives us the change or prior period error. So again, as well as giving the detailed explanation of change in policy, you'll give an explanation of the following prior period errors, the impact of the P&L, the impact of the statement of financial position, and any detail about it as well, if required. And that's all coming from IAS 8, paragraph 45 and 49. You give a detailed disclosure of the impact of any prior period error. So change in accounting policy and material prior period errors, they're accounted for the same. You will retrospectively adjust the prior years, which means opening retained earnings will be adjusted. Right? And that's important. And when you're coming to here as well, when you're doing this, you'll also have to realize your opening net assets will be adjusted as well. So what they've done is they will have increased the depreciation charge by 200,000. Actually, when they credit their motor vehicle accumulated depreciation, assuming it's motor vehicle, could be the other assets, that accumulated depreciation should be increased from the start of the year, as if it was done last year. So while we're debiting retained earnings credit the P&L, your accumulated depreciation will be 200,000 bigger at the start of the year, not just at the end of the year. So you're adjusting, that debit and credit has already been done because you've already credited accumulated depreciation 200 if you've brought into year one. All you're doing that now is at the start of the year instead of the end of the year. So it's just to bear that in mind how you present it, particularly if more likely in an exam question you will be asked to do the statement of changes in equity as well. Leo is another example where you've discovered capital expenditure on new machinery was expensed to the financial statements for the year end 2018. When the error was discovered, management estimate residual value of machinery was 20,000, a useful life of 5 years, and a full year depreciation year purchase. Closing retained earnings last year was 4,288. Profit for this year, 895,200. And your tax is charged at 20% of profit. Okay, so we can see there's an error here. What they've happened is they've expensed it instead of capitalizing it. So if we come down and we look at what the error was, so the error in 2018 was you expensed 420,000, where in fact you should have only expensed the depreciation, because this is capital expenditure, it should have been capitalized. So you should have only depreciated, if we go back and we look at working one, depreciation in 2018 should have been 420,000 minus 20, gets you a depreciable value of 400, and divide that by useful life, 5 years, which is 80,000. So you should have only expensed 80,000. So over-expensed, if that's a phrase, 340,000. So profit was too low. So your profit overall was too low by 340,000. Right? Because you over-expense it. Now, what a lot of students will say there, they'll put in the 340,000 adjustment. The reason you're given tax is the net impact is after tax, which is 340,000 times 0.2. So the tax impact, we'll put there the tax impact first. Tax impact is 68,000. And that means the net impact is 340 minus 68, 272. So what does that mean? Well, it means that if you've over-expensed by 340,000, your taxable profits are 340,000 lower than they should have been. That means you paid 68,000 less tax than you should have, so that has to be adjusted as well. So the net impact is 272,000 of higher profits last year because of that error. All right, so let's just think what the debits and credits would have looked like last year. So in last year's accounts, you would have debited PP cost 420. You would have credited accumulated depreciation. This is the adjustments here, 80, 1 year's depreciation. You will credit the SOPL expenses, 340. You will debit tax, 68, and you will credit tax most likely liability, 68. So that would be the adjustments last year. Now remember, we're not doing last year's accounts, we're doing this year's accounts, and we want to look at the net impact going forward. So there are the errors that would have done. You need to capitalize the expenditure instead of expense it, recognize the accumulated depreciation, credit expenses 340, which is the net of the 420, and the 80 that should have been depreciated, and then recognize your tax impact as well. So net impact is that opening retained earnings in 2019 will be 272 bigger. So when you're doing your statement of change in equity, that's the impact. Your opening retained earnings, if we do it down here, will be 272 bigger. So your statement of change in equity, opening retained earnings, first to the first 19, was 4,288,400, which is the balance that's given, right? Prior period error, it's actually going to be 272,000 bigger because what we said. And restated then, first the first 19, is you add those two together. 4,560, 400. Just make sure that's right. So what we're saying, because we have in here, this figure has profit for 2018 that's wrong because there was a material prior period error. You made a big mistake because it can the impact of the sizable error in terms of expensing it. You need to reverse that. And then your 2019 profit, be careful, that has impacted as well. 2019 profit that will come from your SOPL. The profit here is 895,200. Now remember that 895,200 has no expenses and no depreciation. So it should have another 80,000 depreciation taken off. So that's going to be 895,200 minus, in this case, 80,000. So you're taking 80,000. Now, some people will say, well, that 80,000 then is going to be multiplied by 20% plus 16. So where is that coming from? I'll bring that down because it might make it easier. That is the tax impact. So what you're saying is, if I have a depreciation expense of 80,000, that will save me tax at 20%. Now I know there's a difference between depreciation and capital allowances, which is allowed for tax, but we don't distinguish here. We just look at the net impact, which is the more straightforward one for this IAS 8. So the updated profit, 131,200. So what we're saying is, because we have to charge depreciation now in 2019, because the error wouldn't have charged depreciation at all, it just wrote it all off in 2018. We know that's wrong. You should be charging 80,000 depreciation each year. That depreciation is going to reduce your taxable profits. We're taking that simplistic assumption for now. So that means if I had expenses of 80, it would save me tax of 16, 20%. So the net impact is my updated 2019 profit is 831,200. You don't call that restated because you're only updating the current year. 2019 hasn't been finalized yet, so you just update it as that error is identified. So 4,560, 400 plus 831,200. Closing retained earnings 5,391,600. All right. So it gets you a good idea of what's going on. That's a tricky one now. There's a lot of work involved. So watch when you have tax there, you need to think about the tax impact. That if you're bringing in more expenses, that's going to reduce your taxable profit, which is the net impact. Or if you're taking away expenses, that's going to increase your taxable profit and result in an outflow. In retained earnings, we always look at the net effect after tax, because the figure that goes to retained earnings is profit after tax. So the tax one can be a bit tricky, particularly because you haven't covered tax yet, but we just take the simplistic assumption, whatever your accounting profit figure is the figure that's going to be impacting your taxable profit. That won't always be the case, but for AC220, that's a fine assumption to make. All right, so hopefully that gave you a good idea how to approach it. Right, so again, disclosures, you'll see those already in the model financial statements I've shown you. You have to give detailed disclosures around change in accounting policy, including the effect, the numerical effect on each line item. So we'd have to go back and disclose the impact on cost, accumulated depreciation and tax in the notes to the accounts. You'd only show the net impact in the statement of change in equity, but each of the detailed ones would have to be explained in the notes to the account. Change in accounting estimate, you have to give the detailed disclosures as well, and change in prior period error. So a key part of that is the disclosures that come as part of it. And the model financial statements are probably one of the best ones to look at for that, because in the left-hand margin, it'll tell you IAS 8. So you can control an F for IAS 8, and you can see the references there, what the disclosures are. Because not every company's financial statements will have IAS 8 there. It depends on the year and maybe if they've had any error or any change in that year. In terms of UK and Irish GAAP, overall it's the same treatment. So you don't need to worry about too much differences. That won't be the focus of any exam question, other than you have an idea of where FRS 102 is relevant for. It's relevant for companies that are not listed companies, because all listed companies have to use IAS or IFRS. So your next steps then is have a look maybe at the Darcy textbook or the Connolly textbook. Both of those have good chapters on IAS 8, and you can focus on question pack 12 as well. We will have a tutorial in next week, 2 weeks time, focus on IAS 8. Next week we'll look at IAS 37 and IAS 10. So hopefully you found that useful. That was focused on IAS 8, change in accounting policies, change in accounting estimates, and also material prior period errors.